Hello everyone and welcome to this month's monthly market review for April 2023. My name is Steve Latham. I'm the Chief Investment Officer for Bernanke Wealth Management. And today we want to talk about credit conditions, specifically because we've seen a lot of market participants suggest that credit is going to get tighter, or said differently, lending standards are going to get tighter as a result of some of the bank failures that occurred in March. And while this may be the case, and there certainly could be other fallout from what occurred back in March, we want to take a look at the historical context of credit and lending, and more specifically as it relates to the demand for that credit and lending, because that is really a large component of this as well. If we're thinking that tighter credit standards could mean a slower economic forecast going forward, well, that also revolves around what does the demand look like for credit, both at the corporate level and at the consumer level. And so we have a couple charts that we want to show you here. This is from the Senior Loan Officer Opinion Survey, and this is effectively a survey of banks across the country about what their lending standards look like on both a corporate level and a consumer level. And so this chart looks specifically at corporations. Large and middle-sized firms are in the black, and small-sized firms are in the red. And this goes all the way back to 1991. And if we're looking at this chart historically, we can see credit was very tight back in the great financial crisis, right around 2007, 2008. It got tight again during the COVID pandemic. Obviously, everyone kind of seized up. Nobody was really lending at all. There was also very little demand for credit at that time. But since we saw the recovery through 2021, lending got really loose and a lot of people were spending money because interest rates were near zero. Now that's obviously changed over the last 12 months. The Federal Reserve has gone on an aggressive rate hiking campaign, hiking rates over 500 or close to 500 basis points or 5% over the last 12 to 15 months. And so that translates into tighter credit standards, which is where we're at right at the beginning of 2023. Now we can see the same thing on the consumer side. Going back again to 1991, we can see demand for consumer loans. Specifically, we're looking at credit card, auto, and other consumer loans. And we saw the same thing happen. Really tight credit standards in 2008, tight again during the pandemic in 2020. We got really loose in 2020 and 2021. And as interest rates increased, we saw tightening standards increase as well. Now, the flip side to this equation is if credit is tightening, is that going to slow down the economy? The answer is yes, but only if demand is still high as well. And this Senior Officer Loan Survey suggests that demand has actually been falling for credit as tightening standards have increased. So this chart almost looks like the opposite of what we saw in the past, where there was very little demand in '08 because the economy wasn't functioning terribly well, and it took us a while to get out of that trough after '08 and '09. We also saw demand drop during the COVID pandemic's peak and increase as everyone realized that we were going to be able to come out of that relatively unscathed, although there's a lot of scars that we don't need to go through today. But now, as interest rates have increased, we see the inverse happen, where demand has decreased because it costs more to loan for a car, get a home equity loan, purchase a mortgage. And this has happened gradually over the last year. Now, the same thing on the consumer side has occurred, where back in '08, again, low demand, 2020, low demand, increased, and has since come down as a result of interest rates hiking as well. Now, where we would be more concerned with what this outlook would be is if demand was still high. If we hadn't seen demand come down over the past 12 months as credit standards have tightened, then that's where you can really see a wrench thrown in the gears of the economy, because that shift can happen suddenly if that demand isn't changing with overall trends in the market. But what we have been seeing is consumers and businesses adjust their expectations and adjust their demand for new lines of credit and new lines of loans in order to function as a business. They've been overall reducing costs. They've been shoring up their balance sheets, both the consumer and the corporate side. And they're still relatively well insulated with all the excess cash that was poured into the economy through pandemic related stimulus. And so even though credit could tighten as a result of some of the bank failures and changes within the banking industry that we just don't have a lot of insight into at this point, we've already seen credit tighten over the last 12 months. Any incremental tightening is likely to have less of an impact than if this were an explicit pivot from loosened conditions. And again, on the demand side, because we've seen demand fall over the last 12 months, even though those credit conditions may be tighter, which means that it would be harder to get a loan, consumers and businesses have already adjusted their expectations to that level of tightening. So we don't think it's going to have a huge impact or as large of an impact as what we've been hearing some market pundits suggest as far as greater credit standards are concerned. But it certainly could have an impact, and it's something that we're going to be looking at over the next 6 to 12 months. If you have any questions on this content or any other content that we produced in the past, please feel free to reach out. And with that, hopefully see you next month for the next monthly market update. Thank you.